There's a saying in the intelligence community, the loudest threats are rarely the most dangerous. It is the quiet ones you need to fear. In financial markets, we are conditioned to look for noise. We look for the massive green candle that shoots to the moon. We look for the violent red crash that signals panic. We look for volatility. But right now, if you look at the silver chart in the low 60s range, you see something strange. You see nothing. The price is stuck. It churns. It dips a few cents and then it bounces back. It rises a few cents and then it stops. To the average retail trader, this looks like boredom. It looks like the rally has stalled. It looks like the market is confused. But if you look deeper, if you peel back the layer of price and look at the volume, you see a completely different story. You see a war zone. Over the last few trading sessions, billions of dollars of paper silver have been thrown at this market. Banks have shorted. Algorithms have dumped. And yet, the price refuses to break. Why? Because someone is standing there. Someone massive. Someone with pockets deeper than the bullion banks. Someone who has placed a limit buy order so large that it is absorbing the entire global supply of silver without flinching. We are witnessing the arrival of a mega whale. This isn't a Reddit squeeze. This isn't a hedge fund trying to make a quick buck. This is a strategic buyer, accumulating a position that will change the balance of power forever. In this 4-part investigation, we are going to hunt this whale. We are going to use forensic market data to prove that a massive transfer of wealth is happening. We are going to connect the dots between the AI energy crisis and the sudden disappearance of physical silver. And we are going to show you why a flat price with high volume is the single most bullish signal on planet Earth. The market isn't boring, it is loading. And you need to be on the same side as the whale. To understand what is happening in the $60 range, you have to understand how smart money buys. If you or I want to buy silver, we log into our brokerage account and hit market buy. The price ticks up a little bit. We get our shares. But if you want to buy $650 million worth of silver, which is roughly 10 million ounces, you cannot just hit market buy. If you did, the price would spike to $100 instantly. You would slippage yourself to death. You would ruin your own entry price. So what do? You use an iceberg order. An iceberg order is a special algorithmic trade used by institutions. It places a small visible order on the books, say 5 contracts. But hidden underneath, in the dark pool, is a massive order for 50,000 contracts. Every time a seller hits the 5 contracts, the algorithm instantly reloads them. Sell 5, reload 5, sell 5, reload 5. The price doesn't move, it stays pinned at your limit price. But the volume meter spins like a turbine. The sellers think there is infinite demand at that level. Eventually, the sellers run out of ammo, and once the sellers are exhausted, the whale removes the wall, and the price gaps up violently. This is exactly what we are seeing right now. Look at the chart in the $63 zone. Every time the banks try to smash the price down, it hits an invisible concrete floor. It doesn't bounce, it just stops. That stop is the whale's mouth opening. We estimate, based on the volume turnover in the last 48 hours, that a single entity has absorbed roughly 10 million to 15 million ounces of silver. That is roughly $650 million to $1 billion in capital. Who has that kind of cash? It isn't a standard hedge fund. Hedge funds are scared of commodities. It isn't a retail mob. Retail is tapped out. It isn't a bullion bank. Banks typically sell into rallies. They don't defend floors. This footprint belongs to a strategic corporate entity. A company that needs the metal, not to trade, but to survive. A company that views $63 not as expensive, but as cheap insurance. We are watching the accumulation phase of the century, and the longer the price stays flat, the bigger the explosion when the whale is full. What we are witnessing in this consolidation zone is a handoff. It is a transfer of ownership from weak hands to strong hands. Let's define the players. The weak hands are the speculators who bought at $50 hoping for a quick flip. They are nervous. They see the price stalling at $63. They are terrified of a crash. Every time the price dips, they panic and sell. They are providing the liquidity. The strong hands are the buyers. They are not nervous. They have a 10-year time horizon. They are buying the panic. This process, where volatile investors exit and long-term holders enter, is essential for a supercycle. It builds a base. Think of it like pouring concrete. If you build a skyscraper on mud, it collapses. If you build it on concrete, it stands forever. The $63 level is becoming the concrete foundation. The fact that the price is not crashing despite the massive gains of the last few weeks proves that the market has fundamentally changed character. In 2011 or 2020, a vertical rally was always followed by a crash. Why? Because it was driven by paper speculation. When the hype died, the price died. Today, the hype is dead, but the price is holding. That is the tell. Demand is no longer discretionary. Someone has to buy. This handoff is invisible to the casual observer. The casual observer sees a flat chart and says, silver is dead. The professional sees a flat chart with high volume and says, silver is being cornered. We are watching the free float of the market being sucked into a black hole. Once the weak hands are all gone, once the last nervous speculator has sold his position to the whale, there's nobody left to sell. And that is when the price enters price discovery. But how do you know it isn't the banks covering their shorts? This is the most common question I get. Isn't this just JP Morgan closing their position? It is a fair question, but the data says no. Here is the forensic evidence. Evidence A, the time of day. Bank buying usually happens during fixing hours or right at the close. The buying we are seeing is constant. It is happening in the Asian session. It is happening in the European session. It is happening in the US pre-market. This is algorithmic accumulation designed to minimize market impact. Banks covering shorts tend to be more volatile and desperate. This buyer is calm. Evidence B, the physical premiums. If this were just paper short covering, the spread between paper and physical would narrow. But the spread is widening. Physical premiums in Shanghai and on the US wholesale market are rising, even while the paper price stays flat. This indicates the buyer is taking delivery. They are stripping the metal out of the system. Banks usually just roll the paper contracts forward. This buyer wants the metal. Evidence C, the sector rotation. Look at the stock market. While silver is accumulating, look at what else is moving. Copper is bidding, uranium is bidding, AI tech stocks are bidding. The correlation is shifting. Silver is decoupling from gold and coupling with the electrification basket. This tells us the buyer is an industrial entity. They are treating silver like copper or lithium. They are securing a supply chain, not speculating on a currency collapse. So if it's not a bank and it's not retail, who has $30 billion in cash, needs massive amounts of energy, and is terrified of a supply shortage? Big tech, specifically the AI hyperscalers. Microsoft, Google, Amazon, Meta. In part 2, we are going to connect the dots that Wall Street is terrified to mention. We are going to look at the $100 trillion AI revolution and why it hits a brick wall without silver. We are going to analyze the recent partnerships between BlackRock and Microsoft. What is AI infrastructure? It is data centers. It is power grids. It is solar fields. It is silver. The whale isn't a mystery. It is the most powerful industry on Earth, realizing they forgot to buy the batteries. You have heard of data is the new oil, but data needs energy, and energy needs metal. We are moving from the digital economy back to the physical economy. AI doesn't exist in the cloud. It exists on silicon chips, powered by electricity, transmitted by silver. An AI query uses 10x to 30x more electricity than a Google search. The grid cannot handle it. So the tech giants are building their own grids. They are building massive solar arrays to power their data centers. And they are realizing that the silver market is too small to accommodate them. So they are front-running the shortage. They are buying the mine before they build the factory. In part 2, we are going to dive into the AI energy crisis. We are going to do the math on how much silver Microsoft needs to power ChatGPT 5. And we are going to show you why this secret buyer at $63 is just the first of many. The banks are fighting the past. The whale is buying the future. If you just watched part 1, you know the who. You know that a massive strategic buyer, likely a tech giant, is absorbing every ounce of silver at the $63 level. You know that this buying is calm, algorithmic, and relentless. But now we have to answer the why. Why would a software company care about a precious metal? Why would Microsoft, Google, or Amazon be secretly accumulating silver? They aren't building jewelry. They aren't minting coins. They are building the brain. We are in the early innings of the artificial intelligence revolution. Wall Street is obsessed with the chips, the NVIDIAs and the AMDs, but they are ignoring the lungs. AI doesn't breathe air. It breathes electricity. A standard Google search uses 0.3 watt-hours of energy. A ChatGPT query uses roughly 3 to 10 watt-hours. That is a 10x to 30x increase in energy density per click. And as the models get smarter, as we move to artificial general intelligence, the energy consumption goes exponential. The grid cannot handle it. The US power grid is old, fragile, and maxed out. So the tech giants are facing an existential crisis. They have the chips, they have the software, they have the customers, but they don't have the power. In part 2, we are going to expose the AI energy crisis. We are going to connect the dots between the massive AI infrastructure funds recently announced and the sudden disappearance of physical silver. We are going to show you why net zero commitments have forced big tech into a corner where their only escape is to buy massive amounts of silver. The whale isn't speculating on price. The whale is buying electricity in solid form. You don't have to guess what the whales are doing. They told us. We just weren't listening to the right frequency. In late 2024, a partnership was announced that changed the world. BlackRock and Microsoft launched a $30 billion artificial intelligence infrastructure fund. Read the fine print. What is AI infrastructure? It isn't just servers. The press release explicitly stated to build data centers and the energy infrastructure to power them. $30 billion. Now let's put that number in perspective. The entire annual global mine supply of silver was worth roughly $25 billion. This one fund has more capital than the entire annual production of the silver mining industry, and that's just Microsoft. Amazon has committed billions to renewable energy. Google has committed billions. Meta has committed billions. They are sitting on a combined war chest of over $100 billion dedicated solely to building power generation. And here is the catch. They have all made public commitments to be carbon negative or net zero by 2030. They cannot build coal plants. They cannot build natural gas plants. Nuclear takes 10 years to build. Wind is unreliable. That leaves only one scalable, deployable, carbon-free energy source that can be built in 12 months. Solar. They need solar, not a few rooftop panels. They need gigawatt-scale solar farms covering entire counties to power their data centers. And as we established in previous videos, you cannot build a high-efficiency TOPCon solar panel without silver. So do the math. If Microsoft plans to deploy $10 billion into solar infrastructure, and silver makes up roughly 10% of the cost of a solar panel, that is $1 billion of direct silver demand from just one company. That matches our Iceberg Order perfectly. The $650 million accumulation we are seeing at $63 isn't a hedge fund. It is a procurement department. It is Microsoft, or a proxy acting for them, securing the raw materials to ensure their $30 billion investment doesn't fail because of a silver shortage. They are buying the silver paste before they even build the farm. Because they know if they wait until the farm is approved, the silver won't be there. But wait, the skeptics say, solar panels are getting more efficient. They use less silver per watt. This is true. The thrifting is real, but it triggers the Jevons paradox. This is an economic rule that states, as technology increases the efficiency with which a resource is used, the total consumption of that resource increases rather than decreases. Why? Because as solar becomes more efficient, it becomes cheaper and more powerful. Because it is cheaper, we build more of it. We don't just put it on roofs, we put it on cars. We put it on windows, we build massive farms in the desert. The efficiency gains in silver usage are being completely overwhelmed by the volume explosion, especially with AI. An AI data center runs 24/7. It requires base load reliability. To run a data center on solar, you can't just build enough panels for the daytime. You have to overbuild the solar array by 3x or 4x to charge the massive batteries to run the center at night. So, for every gigawatt of AI compute power, you need 3 to 4 gigawatts of solar capacity. This multiplier effect is the silver killer. The tech giants know this. They have run the simulations. They know that net zero AI is mathematically impossible with the current global silver supply. So they have two choices. Abandon AI? Not happening. Abandon net zero. PR suicide. Or option 3, corner the silver market. They have chosen option 3. They aren't trying to squeeze the price. They don't care about the price. To Microsoft, $100 silver is a rounding error. To them, silver is just a construction material like concrete or steel. They just need availability. This explains the specific price action we're seeing, the Iceberg Order. They aren't chasing the price up. They are putting a floor under it. They are saying, we will take everything you have at $63. Keep selling to us. They are draining the swamp. This marks a shift in corporate strategy that we haven't seen since the days of Henry Ford. In the 1920s, Henry Ford didn't just build cars. He bought iron mines. He bought rubber plantations in Brazil. He bought coal mines. He realized that to dominate the auto industry, he had to own the resource. For the last 50 years, corporations moved away from this. They relied on just-in-time delivery. They let the market handle the supply. But the just-in-time era died in 2020. The supply chains broke. Chips ran out. Factories stopped. The CEOs learned a painful lesson. If you don't own it, you can't rely on it. Now, we are seeing the return of vertical integration. Tesla is building its own lithium refinery. General Motors is investing in mines. And now, the tech giants are building strategic reserves of critical metals. They are becoming nation states. Microsoft has more cash than many countries. Apple has more influence than many governments. Why would they trust the COMEX to deliver their silver? They wouldn't. They are building their own stockpiles, somewhere in Nevada or Texas or Ireland. There are warehouses filling up with industrial silver, not to trade, to use. The silver is being removed from the global float permanently. It will never appear on the COMEX inventory report. It will never be available for the banks to lease. It is dark inventory. And because it is invisible, the market doesn't realize how tight the supply actually is. We look at the COMEX and see 30 million ounces. We don't see the 50 million ounces sitting in a private vault owned by a shell company of Alphabet Inc. The whale at $63 is building a fortress. And once the fortress is full, they will stop supporting the price. But by then, there will be no metal left for anyone else. So we have identified the who, big tech. We have identified the why, the AI energy crisis. We have identified the how, iceberg orders and dark inventory. But what does this mean for you? What does this mean for the retail investor holding a few tubes of silver eagles? It means you are swimming with sharks. But for the first time in history, the sharks are swimming in your direction. They want the price to stay low while they buy. But once they are done buying, they want the price to go high to squeeze out their competitors. In part 3, we are going to look at the collateral damage. We are going to explore what happens to the other industries that need silver when big tech sucks all the oxygen out of the room. What happens to the medical industry? What happens to the jewelry market? And, most importantly, I am going to show you how to draft behind the whale, how to position your portfolio to benefit from their buying power, without getting crushed by their volatility. The secret buyer is holding the line at $63. This is your signal. The accumulation window is open, but the door is closing. Don't miss part 3. The squeeze gets personal. If you have been following this investigation, the picture is becoming terrifyingly clear. We have identified the whale at the $63 level. It isn't a speculator. It is the AI industrial complex. It is the combined force of big tech and global energy securing the physical silver needed to build the grid of the future. They have a war chest of $100 billion. They have a mandate to reach net zero. And they are currently absorbing the global float of silver through massive, silent iceberg orders. But here is the question nobody is asking. What happens to everyone else? The silver market is a zero-sum game. There are only about 830 million ounces mined every year. If Microsoft, Amazon, and Samsung suddenly demand an extra 200 million ounces, that metal has to come from somewhere. It has to be taken away from someone else. In economics, this is called crowding out. When a giant enters the room and sucks up all the oxygen, the smaller creatures suffocate. In part 3, we are going to look at the collateral damage of this accumulation. We are going to look at the industries that are about to be starved of silver. We are going to look at the medical crisis and the military panic that this shortage creates. And most importantly, I'm going to teach you how to draft behind the whale, how to use their buying power to protect your wealth instead of getting crushed by their wake. The tech giants are eating. Everyone else is about to starve. When we talk about silver, we usually talk about money or solar panels. We forget that silver is the most antimicrobial element on the periodic table. It is essential for modern medicine. It is in burn creams. It is in catheters to prevent infection. It is in surgical tools. And we forget that silver is a critical component of warfare. A Tomahawk cruise missile contains roughly 500 ounces of silver. Why? Because silver is the best conductor of electricity. In a guidance system that controls $1 million weapon, you don't use copper. You use the best. Torpedoes use silver zinc batteries. Fighter jet cockpits use silver-coated glass. Here's the problem. The medical industry and the military-industrial complex are price inelastic. A hospital cannot say, silver is too expensive, let's use plastic. People die. The Pentagon cannot say, silver is $100, let's build cheaper missiles. You lose the war. So, what happens when the tech whale sucks up the inventory at $63? The Defense Logistics Agency wakes up. The hospital procurement networks wake up. They realize their just-in-time delivery is late. They call the refiner. The refiner says, sorry, Samsung bought it all. This triggers a bidding war. Not a bidding war between speculators, a bidding war between national security and public health. The U.S. military has priority. They can invoke the Defense Production Act. They can legally seize the silver before it gets to Apple, but Apple has the cash. Apple has the contracts. This clash creates a vacuum upwards. If the military seizes the supply, Apple has to bid higher for the remaining scraps. If Apple secures the supply, the military has to pay a premium to divert it. This is the collateral damage. The tech whale didn't intend to start a crisis in the medical sector, but by hoarding the float, they have inadvertently squeezed the most sensitive industries in the world. As an investor, you need to understand this. You are not betting on a bubble. You are holding the only asset that Raytheon, Pfizer, and Microsoft are fighting over. That is a very safe place to be. So, who loses? If tech, military, and medicine must have silver, who stops buying? Who gets crowded out? Jewelry and silverware. This is the discretionary sector. India consumes a massive amount of silver for ankles, bracelets, and silverware. It is cultural. It is a store of wealth. But there's a price point where the culture gives way to the cash. When silver hits $50, $60, $70, the Indian demand shifts from buying to selling. The housewife in Mumbai looks at her silver plates and says, that is a house deposit. She sells it to the refiner. The refiner melts it down, and that silver goes to Samsung. This is the scrap cycle. It is the only relief valve the market has. The whale at $63 is counting on this. They are counting on the high price to flush out the old silver from the jewelry market, so they can consume it in the industrial market. But here's the catch. This scrap supply is finite, and it is slow. It takes time to convince 1 billion people to sell their jewelry. It takes time to collect it, melt it, and refine it to 999 purity. The tech whale needs the silver now. The scrap cycle takes years. This mismatch between the immediate industrial hunger and the slow scrap response is what causes the price to overshoot. We are about to see the destruction of the decorative silver market. Silver is becoming too valuable to wear. It is becoming too valuable to eat off of. It is returning to its true purpose, strategic industry. If you own silver jewelry, keep it. It might be the last generation that can afford it. Now, let's talk about you. How do you play this? You're not a whale. You cannot move the market. If you try to fight the whale, you get crushed. If you try to front run the whale, you get shaken out by volatility. The strategy is to draft. In racing, drafting means riding in the slipstream of a larger vehicle. They cut the wind resistance for you. You use less energy to go faster. The Iceberg Order at $63 is your semi-truck. The whale is spending billions to defend this level. They are absorbing the selling pressure. They are building the floor. Your strategy. Number 1, don't get bored. The whale wants you to get bored. They want the price to stay flat so you lose interest and sell to them. Do not sell. Boredom is the trap. Number 2, buy the base. Every time the price touches the bottom of this consolidation range, you buy. You're buying with the whale. You put your stop loss just below their iceberg. If the whale leaves, you leave. But as long as they are there, you are safe. Number 3, watch the volume. As long as volume is high and price is flat, the accumulation is happening. When volume drops, the whale is full. That is when the price explodes. If you are buying physical, where do you put it? The whale isn't using the COMEX. They aren't using bank safety deposit boxes. They are using private, non-bank vaults. You should do the same, or you hold it yourself. The drafting strategy is simple. Identify the big buyer. Do what they do. Wait for them to push the price up. Right now, the big buyer is accumulating at $63. They are telling you, with their wallet, that $63 is a bargain. Who are you to argue with $30 billion? So we know the whale is there. We know they are eating the supply. We know they are squeezing the military and the jewelry market. But an iceberg order cannot last forever. Eventually, the sellers run out. Eventually, the whale fills their bag. Eventually, the limit buy is removed. What happens in that exact second? The vacuum. When the massive buy wall at $63 disappears, and there are no sellers left because the whale bought them all, the price doesn't tick up. It teleports. It jumps from $63 to $65 to $68 in minutes. This is the release of the spring. In part 4, the final chapter, I'm going to walk you through the breakout phase. I'm going to show you the specific technical targets that come into play once the $65 wall falls, and I am going to give you the warning signs to look for that indicate the whale is done buying and is ready to let the price run. The accumulation is the boring part. The markup is the fun part. And the markup is coming. We have reached the final chapter of this investigation. We have identified the whale, the AI tech complex. We have identified the motive, the $30 billion energy crisis. We have identified the victims, the military and medical sectors. Now we are watching the final moments of the accumulation phase. The price of silver has been pinned at $63 for a reason. It wasn't stuck. It was held. The whale placed a massive iceberg order to absorb every ounce of liquidity the market had to offer. But here's the thing about whales. They eventually get full. The $650 million buy program doesn't last forever. The limit buy eventually gets pulled. And when that happens, when the artificial ceiling is removed, we enter the most violent phase of any bull market, the markup phase. In this final breakdown, I'm going to show you exactly what happens when the whale steps away. I'm going to explain the vacuum effect that exists just above $65. I'm going to map out the technical path to $85 and beyond. And I'm going to leave you with the final psychological armor you need. Because the only thing harder than holding through a crash is holding through a vertical rally without selling too early. The accumulation is over. The explosion begins now. Let's look at the volume profile of silver. This tool shows us at what price levels the most trading has occurred historically. It shows us where the memory of the market is. We have built a massive base of volume in the 20s. We have now built a massive base of volume in the low 60s. But look above $65. Look at the chart history going back to 1980 and 2011. Price spent almost no time in the 70s or 80s. It went up through them instantly and it crashed down through them instantly. This creates an air pocket. There are no bag holders at $75 waiting to sell to get their money back. There is no overhead supply. There is no institutional memory of price action there. This means there is zero resistance. Once the price clears the gamma wall at $65, it enters a vacuum. In a vacuum, physics changes. A small amount of buying force creates a massive amount of price movement. If the whale buys 1 million ounces at $63, the price moves 10 cents. If the whale buys 1 million ounces at $68, the price might move 5 points. Why? Because there are no sellers. The sellers have been cleaned out at $63. The only people left holding are the diamond hands who want 100 plus. This is why the markup phase is so violent. You will wake up one morning and silver will be up $4. You will go to lunch and it will be up another $3. The media will scream bubble. But it isn't a bubble. It is price moving through a vacuum to find the next area of liquidity. And according to my analysis, the next major area of liquidity, the next place where sellers might show up, is the inflation-adjusted high of 1980. That is well above $100. The vacuum is the kill zone for the shorts, and we are about to step into it. Before we pop the champagne, I need to give you a warning. The banks know about the vacuum too. They know that if $65 breaks, they die. So before the whale lets the price run, we often see one final nasty move, the stop run. Just before the breakout, the price might dip sharply one last time. It might drop from $63 to $61 in 5 minutes. Why? To trigger the trailing stop losses of the people who bought the bottom. To shake out the last weak hands who are nervous. To verify that there are no more sellers left. This is the springboard. If you see a sudden, inexplicable drop in the next 24 hours, do not panic. Look at the volume. If the price drops on low volume, it is a trick. It is a head fake. The whale is testing the perimeter. They are checking the fence for holes before they release the bull. If you sell into that dip, you're handing your ticket to the conductor right before the train leaves. Stay calm. The structure is bullish. The accumulation is real. The volatility is just the engine revving. The hardest thing in investing is not buying the bottom. It is holding the winner. When silver hits $70, you're going to feel like a genius. You're going to have massive profits. And your brain, your reptilian brain, will scream, sell. Take the profit. It might go down. This is the most dangerous instinct you have because you are thinking in terms of fiat profit. You're thinking, I made $10,000. But you're measuring your wealth in a currency that is collapsing. If you sell your silver at $70, what do you get? You get dollars. What are you going to do with those dollars? Buy stocks? Overvalued? Buy bonds? Negative real yield. Keep it in the bank? Inflation eats it. If you sell your hard asset for soft money right at the beginning of the supercycle, you are trading a thoroughbred racehorse for a pile of hay. The whale isn't selling at $70. They aren't selling at $80. They aren't selling ever. They are consuming it. You need to adopt the whale mindset. You are not trading silver. You are banking in silver. You only sell if you need to buy something real, a house, land, a business. You never sell just to see a bigger number in your checking account. The temptation to sell early will be immense. The volatility will make you nauseous. But remember the energy crisis. Remember the iceberg. The fundamental drivers of this move will last for years, not weeks. Do not eat your marshmallows yet. We have come to the end of this investigation. We started with a flat chart at $63. We uncovered a $650 million secret buyer. We connected it to the $30 billion AI infrastructure spend. And we mapped out the vacuum to $100. The story of silver in 2025 is not about inflation. It isn't about the Fed. It is about physics. We are trying to build a Star Trek future using a Victorian-era supply chain. We are trying to electrify the world with a metal we stopped mining. The math doesn't work. And when the math doesn't work in a commodity market, the price has to solve the equation. The price has to go high enough to destroy demand or stimulate supply. We are entering the era of scarcity. For the first time in your life, you're going to see things you can't buy. Out of stock will be the defining phrase of the decade. By holding silver today, you have secured your seat at the table. You have front-run the biggest companies on earth. You have turned your fiat paper into strategic energy. The whale is done buying. The iceberg is melting. The vacuum is opening. Sit back, watch the show, and hold the line. Subscribe.